Welcome to the May 26, 2025 Advanced Report from McGowanGroup clients and NetWorthRadio.com listeners. Huge money flows this week. There was a pounding in the bond market. They sold bonds all week long. And what happens when you sell bonds? The price goes down and the yield goes up. Look at this, 5.15% on the 30-year Treasury. Look at this. Since 2020, look at that yield going up. Wow, that sent shockwaves in the stock market. Here's what happened to the bond price. Whoa, that is the price of a 20-year Treasury measured by the ETF for the 20-year U.S. Treasury. Wow, that's a huge money flow out the door. Institutions selling Treasuries. What happened and what did it do to the stock market? These are important lessons for bond allocations and stock allocations. Well, the big pounding that we saw in the bond market corresponded to two things. Federal Reserve, including Jerome Powell and all the suits that say whatever he said, oh, these tariffs are going to cause supply shocks. We see future inflation. Now, this is despite some really good inflation news that I'm about to show you. It may be because Trump called Jerome Powell Mr. Too Late, a total loser and a fool. So Jerome Powell's not very happy with Trump at this point. And he didn't cut rates in May. But he's got reason to cut rates on June 18th. And I'm going to cover that. What happened to the stock market? Now, if I get a 30-year U.S. Treasury, okay? 30-year U.S. Treasury paying 5%. Let's say I manage a big pension fund and I got all these pensions and I got projections for what I got to pay out in 30 years. Wow, if I can get over 5% guaranteed, I might take it. And I might not want to speculate in NVIDIA or whatever. I might just want to take some money over there. So I'm going to sell some stock and I'm going to look at doing that. Selling. The Dow went down 900 points on Wednesday. Whoa, that was bad. That corresponded to that 5.15 yield you saw on that long Treasury. Wow, look at that. So the Dow low was 36,600 this year. The high, 45,000. Now we're sitting at about 41,500 or 600 here at the end of the week after this pounding. And what did Trump do about it? On Friday, he tweets, oh, tariffs for Europe go up to 50% on June 1st. Never mind, that's less than one business week notice. And of course, that didn't help matters at all. All right, so you got pressure on the market after a nice recovery here. The Dow year to date is now -2. It had achieved break even briefly right in here. Break even was better than this. And so we go, what's happened to inflation? I told you I was going to give you some good news. Well, and it surprised me that the Federal Reserve goes on their magical mystery tour with the message, tariffs cause inflation. Don't forget that message. We're about to see what really happened the last time there were a bunch of tariffs put on. And they say tariffs cause inflation, you're going to have supply shocks. It didn't happen in April. And GDP came in at 2.4%. for the quarter so far. So there's not disruption, which I would have expected inflation and disruption in economic activity. By the way, I'm Spencer McGowan, your financial weatherman, president, McGowanGroup Wealth Management. Thank you for tuning in each week. And you'll have several more reasons to subscribe by the end of this video. So go ahead and hit the button now and like it if you find it valuable. What is this? This is massive inflation, right? We're looking at year over year, consumer price index, how much the prices go up. This is when everybody, 9%. Everybody's saying, oh my God, it's 1980 all over again. And we're going to have massive inflation. It's going to be terrible. And I should just buy gold or something else. I don't know. Anyway, 9%. By the way, energy infrastructure, one of our dividend allocations, happens to be historically one of the best inflation hedges that you can own. So we'll get to that later. All right, so 9%. We go from no inflation, right, after the pandemic to 9% inflation Everybody's worried about it. Healthcare costs going up, everything going up. Everybody's car insurance going up way too much. Whoa, what happened here? This is the best year-over-year reading we've had since they started printing and spending too much money. Wow, that was great news. Federal Reserve should be celebrating, and they should probably cut rates on June 18th. That's not the most important thing. It means rates are coming down. 4.3 is the current Fed target on cash rates, and that should come down to 2.3 over the next 2 to 3 years. Wow, strategy. This is why you tune in as well. We want to be good at 4 things in the portfolios. McGowanGroup model portfolios, serving affluent families right from the Crescent here in Dallas. We want to be good at tactical safety. We'd like to have a big pile of cash, and if there's market correction, we can put it to work. And we can buy growth with income, dividend companies, growth with innovation. We want to be good at the tech side too. We just want to be smart about it. And then high cash flow, global lending. We want our portfolios to be like a little bank. You got a bunch of loans and bonds, you get interest every day, and sometimes you can buy those loans and bonds cheap. So back to the bond market. All right, now here we've got what happened to a zero coupon bond. A zero coupon bond means you don't get nothing till the end. And this happens to be like a 25-year U.S. Treasury. PIMCO runs this ETF. Whoa, price got smashed. Now we're going to hearken back to the tech wreck. How did we make money during the tech wreck and those lean years? You had the 08 crisis. So from 2000 to 2012, stocks went way down and then way down again, and then they broke even. How could you make money during that period? Well, this was one of the secrets. Junk bonds, B-rated corporate and government bonds all around the world called global high yield. That's part of the high cash flow. Back here, you had the bankruptcy of Russia and long-term capital management. You had a big old emerging market crisis, and this is one of the tools that we used. Well, I took the total return because you get a dividend every month. And you could see it's not without price risk because you had lost money right here, right? That's the 2008 crisis. And bonds tend to go back to par value. And after it did, it was a 16% annualized return, most of that in cash. And what was the Dow and the S&P during this period? It was still negative right there. Bond strategy matters. And sometimes the right bonds at the right price can make all the difference. And this is proof. All right, so here, what is this? This is the S&P 500 2018-2019. Well, what happened? In June of 18, Trump comes out, puts a bunch of tariffs on, 50% on washing machines. And what did the press say? Global recession, massive inflation. What really happened? Well, the S&P started here. The Federal Reserve was in a tightening cycle. So you got a little bear market here that didn't last long. And you finished going from about 2,700 to 3,200 over the 2-year period. So the S&P finished that massive tariff period pretty good. But you say, wait, there would have been inflation, disruption, maybe a recession. No, here's what happened. This is the GDP. Well, that's the economic growth. We did have a bad quarter right here, but it was still growth. And a year after the tariffs went in, GDP was 4.8%. That is massively good by historic standards. The last 20 years have been about 2.1%, by the way. So that's a huge accomplishment. Finished at 2.8% on the final quarter of 2019 before the pandemic. Did we get inflation? Okay. Inflation now when the tariffs went on, it was the middle of 2018 and inflation was 2.9%. Okay. Right now it's 2.3. Then inflation during the tariffs went all the way down to 1.5. And you finished 2019 at about 2.3%, which is kind of where we are right now. So that premise turned out to be wrong. I'm Spencer McGowan. Thank you for tuning in, and we'll be back next week with strategy that you just can't get anywhere else. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.